Hello everyone, this is Justin Paolini, trading performance coach here at Building a Trader. Welcome to our second installment of Tales from the Trenches. Before we start, let's just go through the risk warning. Trading foreign exchange carries a high level of risk and may not be suitable for all investors. The high degree of leverage available can magnify profits as well as losses. You can lose more than your initial deposit. So before trading, please carefully consider the risks and the internet costs and seek independent advice as required. Please contact us to discuss any questions or concerns you may have because we are here to help. And with that said and done, in this video we are going to talk about starting with the right information. In our first video, we talked about who should trade, who can trade, what is trading. In this video, we're going to take this a step forward and we're going to talk about starting with the right information. There is an enormous amount of information available on the internet about trading. There are more than 10,000 books on trading that have been written, including my own. And on the internet, you have all sorts of people talking about trading, the right way to trade, how to trade, strategies, and whatnot. So in this video, I want to give you some clear and concise pieces of information that you can use to start on the right foot. The first thing you need to know is that 90% of traders lose 90% of their capital in 90 days. Okay, that's an old adage from the broker days, but it's kind of true, and it remains true to this day because people generally, as a group, do not change. And to prove this, I love using these charts. This is a chart from my FX book Outlook, and basically what it shows you is the positioning in aggregate of retail traders with live accounts. Okay, this is only data taken from live accounts. And this is the euro dollar. So you can see that from the start of January, during the downtrend, in aggregate, the retail market on my FX book was long on the euro. And then during the rally, it flips to short. And then during this range contraction, of course, it flips from long to short until we get the clear breakout and the market is steadily short all the way up, It remains short except for one brief glitch here, short until just a few days ago, and then short again. So what I want to do is to give you the kind of information that can help you be on the right side of the market, not fighting trends, not fighting momentum like you see people doing in this chart, and keep your trading method as simple as possible to keep you as consistent as possible. So let me toot my own horn for a moment. The first place where you can find all of the information you need in one place is my book, Building a Trader. You can get it for a ridiculously low price on Amazon in Kindle format, or you can buy the hard copy. It's a bit more expensive because it's in color. But I've condensed all my 15 years of trading experience into this book. So everything that I've learned, everything that I've gone through, all my experiences, and what has helped my students, it's all in here. The second best piece of information, which is free, which will keep you on the right side of the market, is my systematic trend filter. Now you can find this in the links below the video, but you can also find it here at buildingatrader.com/the systematic trend filter. You can also Google it. Basically, this filter is something I designed. It helped me sending out institutional trading signals to clients at 3C Analysis during the brief spell I worked there. And it is non-discretionary, no indicators used, but it keeps you on the right side of the market. And I encourage you to download this resource and try it out for yourself. At least I'll be sure that you're not fighting or fading the market, but you're actually looking to follow trends, follow momentum, and this will keep you on the right side of those moves that kill most other traders. And it also keeps you out of a lot of trouble. The common belief is that trading requires complex methods and a high intelligence factor. Okay, but now reality is that you need to keep your model as simple as possible, especially on the retail side. Okay, but even some of the best traders that I've been in contact with that follow a rules-based discretionary strategy have very simple rules because they have to be clear rules and there has to be minimal discretion involved. This helps you be consistent. Okay, now to be consistent, what you have to do is you have to analyze your trading in batches of 20 or 30 trades because the results of any single trade are random and you can have consecutive losses simply for the law of large numbers. Okay, so don't analyze one trade, the next trade, analyze batches of trades. And then you can come out with some decent conclusions about the statistics you've generated. You have to learn to lose well. Okay, now to lose well means having a good handle on your position sizing. Okay, so for example, even if you risk 0.5% of your equity on any trade, that's better than risking just any amount or risking based on conviction. Okay, don't do that. Fixed fractional position sizing will keep you out of trouble. And then seek to understand the nuances in your trading system. Okay, you need to have done the work to understand what you do well when you're successful and do more of that, and understand what you do when you trade poorly and avoid doing that. The other thing is that you need a multiple step exit strategy. Okay, the exits should be a bit more complex than your entry. And then you need to know that discipline and grit are more important than your intelligence. What are some of the things that block people from becoming consistent traders? I want to start from the main hindrance, which is the fear of losses. Okay, the fear of loss really takes people down the wrong path from many different points of view. This is just one chart that I've taken from my FX book because it's a great collection of bad trading habits. This is what people tendentially flip to when they start incurring and trading losses. Instead of being able to focus on the method and and working on their skills and improving their skills, what they actually do is follow that fear of losses and try and dedicate their whole system building effort to not losing. And so they come out with these tremendously consistent high win rate systems. But if you look under the hood of these high win rate systems, they're running a negative skew strategy because they're frequently holding on to losses. Okay, while they're trying to get those minuscule profits, they hold on to losses which are much, much bigger than their profits. Okay, and their losses are, of course, much bigger than their profits. So their whole expectancy, their whole the survivability of their trading career depends on this consistent win rate. But holding on to losses and having negative skew strategies eventually turns into this. Tremendous losses. Sooner or later, the system breaks down. So, the only thing to do is to tilt the odds in your favor and learn to manage your trades properly. It's not about the win rate. It's about how much you win when you win, and it's about keeping your losses as infrequent as possible and as small as possible compared to your wins. Because the vicious cycle is this: if your wins are smaller than your losses, then there's a tremendous amount of pressure on you to not lose. So there's no room for losses, and you always have this need to be right, and you're always working on being right. And that is a bad place to be because you're never relaxed when you trade. Okay, it's tough enough to trade with a consistent system when you're not paying attention to the need to be right. This will just derail any efforts to build a proper system and execute that system. Okay, so focus on the relationship between the risk reward and the win rate. Okay, remember, the larger your wins are, the smaller the win rate has to be in order to break even. Okay, so break that vicious cycle. Focus on having higher average wins to average losses and reduce your psychological pressure. All this is required in order for you to remain consistent. Next free resource for you, the FCI Markets Trader Foundations video series. The link will be below this video. As you know, I am head of trader development at FCI Markets, and I have produced all of their educational content. So the information you will find on their videos, now in particular, I did up this Foundations video series, it's a playlist into itself, that takes you from A to Z, from consistent trade ideas all the way down to trade management and market mind games, okay, trading psychology. I did these videos up in evergreen format, so they remain universally valid, and I would really encourage you to check them out, download them, and just review them and keep them somewhere safe. Here are some of the hindrances that I went through in those videos about consistent execution. The first thing is traders don't specialize. They try to be jack of all trades. Okay, that's inefficient. It won't work. You need to specialize in one thing and do that thing at a world-class level. The other thing is that if there isn't a setup, there isn't a trade. Don't look for setups. Don't look for opportunities to risk your money in the markets. Wait for the market to set up for you. Okay, wait till the trade is just staring you there in the face. The third thing is no proper backtesting or record keeping. Okay, so I'd encourage you to use, for example, a backtester like Forex Tester. You can get a 25% discount as a member of Building a Trader on Forex Tester, so it helps you. Then we have anxiety, the anxiety of FOMO, fear of missing out, jumping the gun, or over the lack of control on your results, right? A lot of traders, and this takes you back to, of course, the fear of losses as well. A lot of traders have trouble just letting go and following their model independently from the outcome. Okay, but we need to be process-driven traders, not outcome-driven traders. Then, a lot of problems come up when traders trade too large. So, if you trade too large, if your position sizing is way out of boundaries, you have less psychological capital, less tolerance for market movements. The time of day, you have to know what time of day is most appropriate for your model, for your instrument. Then, of course, there's a lack of understanding of the system you're using. So, for example, a lot of traders, they come to me for coaching, and they ask me exactly what the rules are for taking a trade and for avoiding a trade. They try to trade my trades instead of using the principles to trade their trades. Okay, so what you need to do is you need to take up the principles of whatever system you're using, make them your own, and take your own trades, because that's how you take responsibility for your trades, accountability for your trades, and ultimately that's how you perfect the kind of understanding and knowledge you need in order to do well. Then we have to talk about the system hopping tendency. A lot of traders search for the Holy Grail. They think there is one best way to trade, and they go and search for that. Of course, that doesn't exist. There are many different ways to trade. There are many different strategies out there. There are even some good strategies on the internet. But essentially, you have to find the strategy that fits your goals, your objectives, your time availability, etc. It has to fit you. Other traders just scan social media for profitable traders to copy. Now, once again, there's just no accountability, no responsibility for that kind of process. And plus, it seems to be a given that nobody loses on social media. Everybody's a winner. So you really can't discern between the good traders and bad traders on social media. And to be honest, I don't know many consistently profitable traders that spend time on social media. Okay, most of them are doing their own thing. If you do this, of course, if you try and copy others, you're going to consistently doubt your own research. Then you're going to still have fear of unknown unknowns. So, you're always going to be looking for that piece of information you don't know. You're going to be looking to others for their ideas because you think they know more. In reality, you have to realize that everything you need is already inside of you. You have to follow your own instincts to find the system that fits you. You have to follow your own insights and learn about that system in a way that makes sense to you. This way, all of those unknown unknowns will disappear. But until you do that work, until you actually trust yourself and trust your instincts and do the work that's necessary, you'll never get there. The other thing is you got to realize that everything works some of the time, but nothing works all the time. And that just plays with people's minds. The other thing is remember to have patience. It's not about short-term gains. It's about consistency. And remember, we talked about analyzing your trades in batches of 20 or 30 trades at a time. Then, people have a wrong view of what trading is. Okay, now we talked about this in the first video of Tales from the Trenches. And then money. When money comes into the picture, all of our good intentions are just thrown out of the window. And that's why you need to demo trade. You need to do all the work, and then you need to trade on a simulator, whether it's just a demo or whether it's something like Forex Tester. Doesn't matter as long as you are doing the simulations and you're finding consistency, and that way you can then transition to a small live account and things should go better. The thing that really got me when I was learning how to trade is this fact here, knowing that the game can be played in many different ways, but without interaction with a successful trader, how can you actually develop that confidence that what I'm doing is sound? And that's why Building a Trader exists. That's why I believe in coaching traders, because by working together on a one-on-one basis, we can overcome all these issues. Traders also use technical analysis to justify their own views instead of using technical analysis to manage their trades or to get decent execution. Okay, this is just a screenshot I pulled up from somebody on TradingView. It's not a direct accusation of this trader in particular. It's just an example showing the kind of clouded charts and unclear charts that people sort of use, and it's impossible to trade like this. Then we have to talk about trade management practices, okay? Because I think trade management is one of the aspects of trading that is least discussed on the web. And instead it's one of the most important aspects of your trading process. So know trade management mathematics. Okay, as soon as we deploy capital in the market, our job should be to limit our risk and manage it in the most efficient way possible. Okay, so the necessary ingredients to do this and the responsibility, okay, of that result. Here they are. The average profit needs to be larger than the average loss. Okay, you should aim for a 3-to-1 ideally over time, but 2-to-1 is what's required, at least. Now, what decides the average profit and average loss of your trades? Your stop loss and your trade management. Okay, it's not the system, it's the stop loss and the trade management. The smaller stop losses, you'll have more frequent losses, but you have larger gains. And instead, trade management. With good trade management, you will learn how to maximize the favorable excursion of your trades, and you will learn to design rules that will help you cut the trades when they're not performing, hence allowing you to take very, very small losses or cutting trades that aren't doing anything and freeing up capital for better trades. So you get really, really good at holding on to trades that are performing and cutting trades, cutting anything that really isn't performing. Then your losses must be less frequent than your gains, okay? So over time, we're going to have a 50% win rate for good, but there are periods, and we should try and maximize those periods where we have 55, 60% wins or even better. Okay, and this is done in the system part, right? In the execution part. So knowing the nuances of your system and monitoring market dynamics, knowing when the system is going to work well, and knowing when to remain out of the market. And then, of course, you must have some home runs, okay? And this goes back to the trade management component. Okay, you must have some really big wins so that you can take that pressure off and never worry about losses. Let me recap the resources that we talked about that have the right information that will keep you on the right side of the market and help you develop a consistent trading model. Number 1, my book, Building a Trader, Lessons from the Trenches. That's on Amazon at a ridiculously low price. The Systematic Trend Filter. The link will be in the description below, but you can also find it here. The FCI Markets Trader Foundations video series. You can find that on YouTube. The FCI Markets Free Trader Foundations course. And you will find the link also in the description of the video. Here are my concluding thoughts. If you learn how to trade, then it doesn't make sense to trade your own capital. I want you to know that I have a pathway open for you. It's a pathway that takes you through evaluation to become a funded trader with FCI Markets. They can fund you up to £1 million, and your profit split depends on your Sharpe ratio. There is no fee, so this is not a prop shop. This is an actual funding scheme where you get in based on merit. Okay, there is your allocations are reevaluated every quarter, so every 3 months. But if you are consistent in your trading, this is what you need to aim for. There will always be opportunities awaiting if you can become consistent in your trading. So focus on the process, focus on your skills, and know that there are always better things in your future. I look forward to seeing you in our next video. Good luck.